got to eat something other than gummies today. It's getting out of control. Who needs a 10-pound bag? Was that 10 pounds? Oh. Hey, what's the shipping on that? You know what I mean? Well, yeah, they don't break, but yeah. Hey, welcome to the Closing Beat, everybody. Happy Thursday. How we doing out there today? All is good. Things in the way. Hope all is good with you here today. This is the Closing Beat stock market update show that we do, just like to do it to keep you updated, maybe teach you something new. And I got some goods for you here today. Ahead of our class tonight, Wine and Wealth. Thursday nights we do for clients. Tonight we're going to go over the portfolios. We're going to do the performance, do all kinds of good stuff there. And so if you're one of our clients, come hang out with us. We'll be in the speakeasy there later. Grab a drink, hang out. I'll stick around as long as we have to answer questions like I always do, and we'll have some fun there. But as far as the stock markets today, they had a little bit of fun. Not bad, it was a decent gain. We're getting a little extended here in the short term, but I'll tell you, the action, if we look over at the S&P here today, the action, no matter what index that I talk about here in a moment, was growth-oriented. So this whole transition, we put it in the notes from Jazz email, but this whole transition or phase in the market right now has been led by the FANG stocks, in Microsoft and NVIDIA, little PayPal. And so it's just these handful of stocks that have lifted the markets in this last run, whereas every other stock in the index or S&P, Nasdaq, whatever, it's kind of just floated along. Some winners, some good stuff there. And so it's a really interesting time because before, I shared this with you on the show, 2 days ago, where we talked about all the big movers, the high contributors in the S&P versus all the other stocks, the top 7. They had a period of time, I think we talked about this in September, where they were the only reason that the markets were moving higher. Everything else was kind of going down. It was trending lower. But now we have the exact opposite. We had every other stock moving higher and flat, nothing from these FANG stocks. Well, that's changed in the last couple of days where the money has gone back into FANG stocks and lifted the markets through this second move here. And so thus you have this rally over the last couple of days that hasn't been amazing, but still a pretty good rally. No complaints, really. And if we start with the Nasdaq, it's nearing 7% year to date, also getting back to that prior high. If you want to take a look there, where are we at here? About 13,850 right in there is that prior high. So we're getting really close there. Your mega cap growth stocks today were responsible for more than half of the day's gains in the Nasdaq. So just a handful of stocks accounted for over half of the gains in the Nasdaq. That's your Amazon, you know the names, right? So that's your Amazon, Microsoft, Apple, Tesla. Look at all these at highs, right? Apple's even waking back up, finally getting something done here. Couple honorable mentions in the Nasdaq. You got Peloton coming off the 200-day. We talked about that the other day. It looked like it was starting to get going. That officially did move off the 200-day. You've also got your virus-related stocks just sort of waking up a little bit after being uneventful there. DocuSign gets a Bank of America upgrade. They got a $250 price target on that one. They said they think that their revenue growth is going to grow by 25% over the next year. So it's pretty ambitious considering they are kind of the go-to e-sign product out there, 850,000+ clients. So very cool to see that. A little bit of a rally going on there. Maybe that's the start of something. I think it's a little early. You've got the Dow. Almost to new record highs there, right at 10% year to date in terms of the gains. So all the major indices, they started off the year by spreading out, going all over the place. Now they're coming back in. You got everybody right around that double-digit area. Goldman Sachs, one of the reasons for the rally today. They've got earnings coming up here. We're going to cover that in detail in a second. Goldman Sachs up 1.5% on the day. It was the biggest contributor in the Dow, by the way. Salesforce.com also had a decent day, but it's right back to the 200-day moving average, which is always my red line on the charts there. We go over to the S&P 500, also about 10% year to date, right? They're all sort of converging right around these double-digit gains there. Lately, the rally has been due to Apple, your Amazon, Microsoft, Tesla, those big 7, right? I don't know if we call them FANG anymore. We'll call them the big 7 just to keep that one in, so we know what we're talking about. Microsoft did hit new 52-week highs. Decent rally here over the last couple of days for Microsoft. It's normally not that big of a mover there, but doing pretty good there. I would argue extended in the short term. Here's the deal. No show tomorrow. We've been kind of cutting out the shows on Fridays for now. Just we've all got a lot going on, and it's just been busy really. But working on some software and stuff in the back end. But going into next week, the focus turns back to earnings. We got the start of that sort of first quarter earnings going on next week. And as is typical, we start with the bank stocks next week. There are 23 names that will report next week, which doesn't sound like a lot, but then it's off to the races. Then we're going to go crazy there with a lot of them. Next week, by the way, of the 23 names, there are 16 of them that are financial stocks. Now, anytime you have that many names in a sector reporting, in a sector that's also not very large, quantity-wise, you want to pay attention to what's going on. These financials can move the market. So what I did is I put together a little bit of a slide for you, by the way, here. Oh, hey, I could probably go back and show you real quick. This is what I was talking about a minute ago with before. In September, we talked about this. These stocks, these 7 making up a quarter of the S&P, were leading the way where everything else was generally trending lower, and now what we had most recently was these guys were quiet. Everything else was lifting the boats there, but that's changing. So just to go back to what I was saying a second ago. Nonetheless, let's go to earnings season here. So here are the bank stocks reporting earnings next week, and I'm going to do something rare here. I'm not just going to fly through this real quick because there's a lot of good stuff here. What I did is we put the ticker, in case you want to look it up, the name in case you're not familiar with who they are, the date that they're reporting, starting on Tuesday. They all report in the morning, so I was just trying to highlight that for you. This is the number of occurrences that we are using to come up with all the data to the right. So, for example, I'll use Goldman Sachs. A very popular name, obviously. Goldman Sachs reports on Wednesday in the morning. We've used 77 prior quarters to try to figure out what their stats are. They beat on earnings 87% of the time, reporting their earnings, which is one of the better. I think it's the best, actually. It's the best one, actually, in terms of earnings beats. Beats on revenue 76% of the time, also taking first place there. So this would be the most obvious one to bet on beating earnings. Doesn't mean the stock's going up. It just means that they have a good history of doing that. The average gap, I wanted to show you, when you wake up in the morning and they report their earnings, the market opens, the average gap is slightly positive there. The average intraday move is to sell off from the opening gap. In other words, what we're trying to say is it tends to start with a little bit of excitement, but when the market opens up, it bleeds off, loses that excitement, and turns into an average loss of a very insignificant amount there. But generally speaking, even though they beat on earnings and they're one of the better performers in terms of reports, it has an average negative day. So maybe one you would say, all right, it's basically flat, right? Plus or minus there. If you were looking for a strategy to play there, you really wouldn't want to be directional. You would be thinking, all right, for earnings, I don't expect a whole lot in one way or the other. Average volatility, too, is very low relative to everything else. Banks don't tend to be very volatile, but, that's what you have there. And volatility is reported in dollars in this case. So that's what you have there. Now, taking a look at all of this, what can we get from it? Well, the obvious one is down here. State Street is the most volatile one. They do fine, beating on earnings and everything. Tends to be more volatile, and the average move is down. Now, this group here, right, the average gap, the average intraday, and full day, I color-coded them because I want to be able to show which ones are misleading. So in case you see this, you'll know that it's actually not odd. For example, let's take, like Goldman Sachs was a good example. It misleads you because you think it's going to start positive. It sells off throughout the day and turns negative. Anyone that looks like that. So Citigroup is the same way. You've got your stats here. The average gap is positive by about 0.75%, but then it tends to give up all of that and then some, losing about 1.19%, so finishing the day down about 0.5%. So that would be one of those reversal stocks. If you see it gap up, it's known, all right, on average, it's what we have to go with here. On average, that would be misleading, right? You would think, oh, I'm not going to fall for that. If it gaps higher on earnings, people tend to sell for whatever reason. I don't know what the reason is, but they tend to do that. Okay, so it could go the other way as well, but you get what I'm saying. Same with Morgan Stanley. I'm focusing on the big names here. They're going to get all the headlines, so we focus on that. Morgan Stanley tends to gap up 1%, but then erase a little bit of that. Still finishes positive. Not too bad. It is one of the more volatile stocks. I'll also point out Wells Fargo. They have the worst track record in terms of earnings beats. It's a coin flip, right? So beating on earnings or revenue is basically a coin flip. Small gap down, small rally throughout the day, but tends to not be enough to recover from the losses. And so maybe that's one where you say, what do I do with that? I don't have anything exciting to do there. Also, some of the better ones here, Citizens Financial, they report later in the week. Average gap is quite sizable. That would be the biggest one out of the group, so you're getting the most action for your short-term traders out there that like playing your option strategies and everything. And it tends to stay with its direction. That's what I get from this. If it gaps up 1%, I can kind of trust that. Tends to wiggle around, give me a little bit more by the end of the day. Average full day move is the best out of all the banks, 1.5%. The same can be said for BlackRock. They're pretty steady as well. Usually no major surprises there. So you got a small gap up, small intraday rally that adds to a decent one-day gain. 1%, in one day is not bad for an average gain. So anyways, that is what I wanted to kind of show you there in terms of the earnings coming up, right? I hope that helps. And we focused on that because they're all in the financials, right? And let me know, what do you think? Is that sort of thing, does that help in any way? Does that let you, for the short-term traders, the idea is that it's supposed to give you ideas. For the longer-term investor, the idea is what to expect. If something out of the ordinary happens, at least you know what traditionally is the ordinary thing to happen there. So we'll break that down. Also, before we get in the sector breakdowns here, consumer credit came out. Turns out you guys are out there racking up a little bit of debt, right? Let's see if I can put this on the chart and make it a little bit bigger. Swing it in here so you can see what in the world is going on. There we go. All right, here is consumer credit. This is the month-over-month change for consumer credit. Had its second largest increase ever, by the way, in terms of people taking on more credit. Right? So what do we learn from that? Like, what does that mean? Well, first of all, there's only one other time in 2017 where it had a bigger percentage change month over month, and most of that was credit card debt, if you go back and look at that. Now, is a spike a good thing or a bad thing? As an investor, right? If you see people are willing to take on more debt, does that make you nervous or does that make it exciting? I would argue that that's kind of exciting, at least in the short term, because it shows that people are willing to take on more debt. If you're willing to take on more debt, you probably either are on one side or the other of the extreme. You feel very confident about the future and the likelihood of paying off that debt, or you're down here struggling and you're getting access to whatever debt that you can. So a lot of people are going to focus on the positive because of the size of the move. You would argue that stimulus checks have largely helped out those that are really struggling, if they're really, really struggling. But those that are, recovering, getting back to normal, are willing to accept more debt at hopefully a lower interest rate there. So I'll add one more thing to it. So far, this spike is all credit cards. I'm going to overlay, and we'll just do a percentage here to show you. Here in orange is the change in revolving consumer credit. We could break it down in any number of ways. We could look at auto loans, home loans, student loans, all that great stuff, but those aren't very exciting. The big change comes in credit cards. Everybody's out there taking on the credit card debt. This doesn't mean that they're getting higher limits. That means they're assuming the debt they have spent, they are going to spend or in process of spending. And so revolving credit card debt is the major driver behind the month-over-month change in consumer credit. I don't normally focus on the economics side of things. It's not very exciting to talk about, but I thought in that case that hits you as well. How do you feel about that? This was last month. Did you go spend a little bit more on a credit card? I think we did here, right? A little bit. So is that you? Are you driving the economy? Do you expect that to continue? And if so, where do you go? Where do you look? That would be retailers, that'd be home improvement, that would be maybe even gas, airline travel, things like that. So hopefully that reopening concept is we want, reopening. We want everybody to be doing well. All right, if we go to the sector breakdown here for the day, it's not much to talk about here. This is split pretty cleanly. You have an outlier. Oh, you can't see me. You have an outlier in the form of tech, which we've sort of mentioned already. You have an outlier to the downside in the form of energy there, and everything else basically held its own throughout the day with a small plus or minus gain. You can also see it over here for the day. Tech was held solid, steady, and just very consistent all day long. Here's a 5-minute chart to kind of show you it just did its thing. It didn't really have any kind of volatility today. Sitting at new highs, looking good. Your biggest contributors, by the way, are all the names we mentioned. Apple, Microsoft, and PayPal. Well, maybe mostly Microsoft and Apple. They make up 40% plus of the tech sector, and they were rock solid today, right? So that that theme lately continues. Look at the bottom side of the list there, that energy suffering a little bit of a down move there. Energy has moved all the way back to its 50-day moving average. Now, there are two ways to look at this. A lot of you are going to say, pull back in energy, I would like to do something with that. I would like to find opportunity. There are two mindsets. One is, I would like to find the discounts. You're the pullback player. The other one is to say, I want to play the strongest of the stocks. So in other words, energy pulled back, but these stocks didn't, and therefore I believe that they're going to be stronger. So you could take either side there, and if you do, you just basically, it just depends on how you're going to sort your list. If you're looking for momentum, you'd actually look over the last 5 days or so. Show me the stocks that are showing that momentum. In other words, I've got a sector that's pulled back. Show me stocks that have not pulled back here. So if I look at something like Devon, not to just so I don't pick the obvious first one there. So we've got energy that's pulled back. We got Devon has basically held tight. It's at the 50-day moving average as well. You got a consolidated sector, and here you have a consolidating stock instead of a pullback. So maybe that's something to look at. If you're looking for pullback stocks, you flip the list, you go upside down here, and you say, well, what do we have here? If you're looking for a pullback stock, you need a location. Our clients know what that means, right? So the class last week, if you want to look it up there, it was last week's Wine and Wealth class. But anyways, if you're going to play a pullback, you don't just randomly say, I think it's pulled back and therefore I'll buy it. You need a location. It could be a moving average. It could be price support. It could be the percentage of a pullback. You need something to use as a location. And so you would do that in this case if you're looking for those pullbacks. So if we go dig in here, if you're looking for pullback stocks, maybe you would look at something like Pioneer. So we'll load up Pioneer, down 6% in the last couple days, and what do you know? It's pulled right back to the 50-day. I'll zoom in a little bit so you can see all the way back down here. Doesn't mean it's going to bounce, doesn't mean it's a good one, but you have your pullback to a location, and that's what traders like to look for, well, in particular in the energy sector. All the other sectors basically remain kind of flat and quiet for the day, plus or minus 0.5% or so, or less even, of a gain. You had two sectors that gained 1% or lost 1%. Everything else was within a plus or minus 0.5% range. That is all you have there. Going on over to new highs for the day. 36 of them, I believe, was the last number. 33, 36, somewhere in there. Here's the thing. You notice that number's going down? So the market's plugging along, but the new highs list is going down. There's a little divergence there, right? Why is that? So the divergence there, very simple to take a look at. That means that there are not a lot of stocks moving the market higher. There's just a couple of them. Right? If the new high list was going up and up and up and up every day, that'd be a sign that most stocks are lifting with the tide or rising with the tide. We don't have that. We have new 52-week highs dropping, but yet the market's going up. That tells you that the big, large weighted stocks in the S&P 500, those are the ones lifting the market here. So another way to see that. All right, you've got public storage. This was one from our research post. I think it's a little overdone. You got a little bit of a topping tail here today. In other words, it tried to make a new high. Sellers stepped in, and you're left with what's known as a topping tail there. So that's public storage. Maybe that move's a little bit overdone in the short term. You got Microsoft hitting new 52-week highs again. I would say a little extended. Hope for a pullback there if that's something you're looking for. Oracle also finds itself extended. It's a good stock. I mean, everything's going really well with it, but it's a little bit overdone. Right? All of a sudden, it's a little overdone in the short term. Micron could be a breakout here. There's two things I don't like about it. And if you've been following us for a while, you know why I'm going to rag on this a little bit. So number one, we've got a series of equal highs. That's all we asked for a breakout. But we used up all this energy to get back to the highs from like $80 to $95, right? So we've used up all this energy. What do we expect? That it's going to do that again and just blast off and take off? That's a tough argument to make there. It certainly could happen, but tough argument to make. The other part I don't like about it is that we have this rally. We're back at highs. All looks good, but we go look at the stock market. It's at highs, right? It's had this great run over the last, 7-8 days now. So you're trying to play something that you want to see explosiveness, but all the explosiveness is kind of faded out of the market. Not to say it can't continue, but you're taking a greater risk that something like MU just can't find the energy from the market or from itself to get things going because of those two things. So a little long-winded on that one, but hopefully that helps. Roth Stores up 3.25% on the day. One of the top S&P stocks, actually. I believe it was like third or fourth best performer today. Roth Stores comes in sixth place, sixth best performer with the breakout here. No real news to talk about there. I think even Roth Stores they had some comments that weren't even quite that positive. Nonetheless, it finds itself at new highs. Hey, we did have one new low on the day. VRTS, there you go. VTRS. I always type that wrong. So new low for VTRS, the one we mentioned the other day. These were all well within 5% of hitting lows. That would be the first one to get you there. The other two, if you like the weak stocks, Vertex continues to pull back towards those lows, looking nice and weak. And Perigo. Perigo is very, very close, continuing its downtrend there. All right, stocks in the news. By the way, growth today outpaced value almost of a factor of 3 to 1. Almost 3 to 1 if you happen to be paying attention there. So it gives you an idea. Another way to see what's actually moving the markets. And as promised, I did close out the trade that I was talking about. I'll go back and show you here real quick. So I did a wine and wealth class on this for clients, but see the spread? The spread between growth and value, first of all, was inverted, but it was also much wider than you normally see. So I had made that play to short value, go long growth, and growth ended up being the reason that trade in particular worked out for a profit. So I'm happy with that. If you want to see the details there and you're one of our clients, you can check it out in the wine and wealth class. But let's do stocks in the news. Apple. So Apple's in the news. Apparently the semiconductors are hurting them as well. They're going to have to delay production on MacBooks and iPads due to chip shortages. Does that continue? Can you imagine prices right now on the sort of B2B market for people trying to buy these chips and everything that they need? Whoa. Probably a lot like lumber and copper and stuff. FedEx in the news. JP Morgan, so great day for analysts to make some really specific comments, right? So JP Morgan, their words were, the stock looks attractive based on valuation and pricing power. That's as close to them telling you to buy the stock as you're really going to get from a comment perspective, not the rating that they give it. So that's what happened there. Twitter, apparently they were going to buy Clubhouse. They were worked out a deal apparently around $4 billion. The deal fell through, but nonetheless, the stock moved higher. So there you go. It is in the news. Other than a few of these, kind of a light earnings day or light news day. Another good one from an analyst was Roku. So it was up about 3% on the day. Deutsche Bank says investors should use weakness to build positions. Now, how hard was that? You know what I mean? Like these analysts come out with all these fancy words. That's pretty clear. Investors should use weakness to build positions. In other words, it's pullbacks are buyable on Roku. Their words, not mine, but they're very clear if you ask me. And Facebook in the news. Love them or hate them, Facebook says, you know what? We have no plans to notify users that were impacted by that data leak where they gave up your email and phone number and all that stuff. They said, we don't have to. It's actually not part of our terms of agreement. We don't have to let you know that your information has been compromised. They've decided not to do that. So that's that one. And lastly, Robinhood, they're going to go public. And Robinhood is the king of raising money when you can, not when you have to. I mean, they had to a little bit ago. But Robinhood is officially raising as much debt as possible. They are adding as many loans as they can and opening and using any and all available credit cards, ahead of their IPO. What would they do that for? Anybody wonder why they would do something like that? Take on as much debt as humanly possible now that all that, filing and stuff is done for going public. Why would we just take on all kinds of debt? I wonder. Is there maybe some way we could pay off that debt once we go public? I'm not so sure. He says sarcastically. All right, I'll take your questions if you have any. While the stream is catching up there, you've got Intuit paying out 59 cents. And Bank of Ozarks paying out 28 cents and Hormel paying out 25 cents. That's pretty much it. Earnings. That's the big focus. Next week's earnings is going to be the start of what probably be a busy earnings season there. Yep. I don't know about that Twitter deal there. That's typically in the high headline tech world. They don't buy people anymore. You notice that? They just copy it. They just make the same code as everybody else. Yeah, hard to buy much on high tide day. Yeah, high tide. I like how you said that. Yeah, it's a little difficult. Almost makes you want to sit back and wait just a little bit. I don't blame you. Sell before earnings. If you mean individual stocks, if you're a short-term trader, a lot of people do that and just kind of wait it out, see what happens. Investors, you wouldn't bother with that so much. That's earnings are used for you to more confirm that your beliefs still are accurate. Yep. You made $7,000 on your W-2 and your wife $1,000. How much will you contribute to your Roth IRA? Can we do $3,500 each since we're married filing jointly? Well, technically, you can. If you're under the age of 50, you could do $6,000. If you are 50, you could do the $7,000. Right? You guys have the earnings to show that. Mm-hmm. Oh, yeah. Can you talk more on that Robinhood thing? I still use the app, so something I should be concerned about. No, it won't affect the users much. You know, them going public is no different than any other product that you use. They go public. It doesn't affect you. You're not a stakeholder, I'm assuming. So nothing there. They're just essentially the short story is if you're about to go public and sell a bunch of shares to get money, then why not get as much money as you can right now? You can always pay it off later, giving their newfound, access to capital. Thoughts on penny stock? I don't look at penny stocks. It's hard to have a technical opinion on a penny stock because they're so easily manipulated. Yep, I don't know. You think you'll see Spotify $250 or $350? What is this? The Price is Right? I think you're saying you think it goes to $250 first before it goes to $350. I would say it goes to $250 before $350, but that doesn't mean it's a bad stock. I think $250 would just be exciting for a lot of people. Yeah. Yep. You need a new car trade. Not touching that one. No. I know, right? Jazz Artist of the Week. We did stop doing that. You know what? If I have to pick one, I'm going Wayman Tisdale. Will be your Jazz Artist of the Week. Hell of a bass player. Yep. Neo and Plug Power with the long-term upside. Plug Power is a little more interesting. I'm a little biased, I would say, but I think Plug Power is a little more interesting. And you also know there's a lot of bottom hunters there on this Plug Power. It had a great run. It's another reason why you don't buy the first pullback after what's known as a parabolic or climactic run. It's always a trap. But I guess I'd have to lean towards Plug Power if you're hunting around for an idea. Yep. Dave's retiring in 2 years. Stay in the market or should pull out to a more stable position. It depends on where you're at, Dave. So I have clients that are retiring and really can't scale back. They have to take the risk, or there's just no chance that they're going to, have money for the rest of their life. And then I have clients that, they're set. They don't really need to do anything else. So I argue, why take the risk if you don't have to? Go ahead, come back out of the market. Find something a little safer. Go a little bit more conservative. But without knowing you, that'd be hard to say confidently. Yeah. But congratulations on the retirement there. Verizon fell pretty good today. Yep. Decent move there. I know a lot of people like this. So dividend stocks. People that pick stocks that they're going to stick around for the dividend, and that's really their focus, like a Verizon, the drops are the exciting moments. That's when they go, okay, I'm in. I want to scale in on drops, hold on rallies, scale in on drops, hold on rallies. Yeah. Don't have any Wally Joiners though. No, can't say I do. If I do, it's by accident. I've got enough to build a house with. Let's say that. I know, right? All right. Yeah. So that's the idea on that, or the I think somebody mentioned AT&T as well. Yep. It's a hard stock to trade, or to invest in for, a move that you're hoping to get 3, 4, 5 months and take a profit or something. That's probably not your first pick. Wouldn't be my first pick. All right. Well, hey, we've got Wine and Wealth class coming up here tonight, so I'm going to get ready for that. Come hang out with me. If you're one of our clients, let's do it. Let's talk. We'll go through the portfolios. Got to catch you up on everything there. And for the rest of you, have a great rest of your day. Thank you so much for watching and supporting us. We'll see you Monday.